My name's Peter Hill. The video content that follows was taken from our Zoom seminar event where we asked 6 experts to cover the 3 big questions that they felt businesses or business owners should be focused on across 6 key areas. Selling, winning business in a socially distanced world. Know your numbers, identifying the key performance indicators for your business and acting on them. Pricing, why smarter pricing is more critical than ever. Taxation, whether it's a great year or your worst ever, tax still has a huge impact. Risk, protecting your wealth and driving new opportunities. And finally, technology, using IT to grow your business. Each expert delivered 3 short videos covering the content. As you would expect, these were filmed on iPhones and in kitchens and bedrooms, so the focus is clearly on what is said and not on the production values. We hope you find them useful.
So, what I'm going to be covering today is 3 questions on wealth and risk. So, first question, what is the biggest mistake people tend to make when it comes to their wealth? I would say the first biggest thing is that people don't tend to think about it early enough, and they don't tend to plan it. And particularly for business owners, they can rely on their business value far too much. These are very uncertain times. Unfortunately, many business owners have already seen their businesses fail, and sadly there will be more to come. So I guess perhaps more than any other point in time, it is absolutely crucial in the current climate to think about wealth protection. Some people, as always in life, some people will be lucky and they'll go ahead, they will not plan. Then they won't plan how they're going to build their wealth. They won't plan the protection of the wealth. But our view is very much you can't rely on luck. When you're talking about your future, your wealth, you want to be in control, and you want to give yourself choice and you want to give yourself options. And that is it. All we're talking about today when it comes to wealth is putting you in control, not relying on external factors. So what we're going to do, I'm going to cover a few common themes, or you could say mistakes, that we see being made across all sorts of clients within our client base when it comes to planning their wealth. Firstly, and the biggest thing is they've actually got no idea what and where their wealth is. This might sound strange, but how many of you actually sit down and could tell me exactly what wealth you have, where it is, what it's worth today? We do it with our clients a lot. Ask our clients to guess their overall net wealth, and they'll often be a significant factor out. Sometimes that might be half, sometimes it might be double the real number. This can be over-optimism, maybe just wishful thinking, or pessimism about the value of their business, simply not understanding what it's worth, or considering things that their house may have doubled in value over the last 10 years and a load of their mortgage has been paid off. That makes a massive difference to the overall wealth position. Not only the numbers, but also where the wealth sits within different assets or different pockets of your wealth. So before you can plan any wealth protection, it's critical to know the numbers. Before you can start to look ahead and plan it, you've got to know where it stands now. Secondly, if that's today, you've then got to look ahead and go, well, what will it be at that point in time in the future? We do this with our clients on something called a wealth report. It's not rocket science. We sit down and cover the things we've been talking about, put it into a simple summary, and it's amazing. You can see the attitudes of our clients change immediately. You can see it sometimes because it's the numbers are nowhere near what they would have expected. It might not be enough for the future, or won't give them the income and the lifestyle that they want. For others, it's a realization that the numbers have grown. They're now significant enough to merit better planning, better protection than they've been doing up to this point in time. Either way, our clients are suddenly in a position to do something about it. And that is the critical thing, being able to do something about it, which they weren't before. The second issue for many of our clients is the realization that the business is generating perhaps 90 to 100% of their income, and represents maybe 75 to 90%, 95% of their overall wealth. This reliance on their business for their entire financial future is often a shock, despite the fact that you might think it's quite an obvious thing for most business owners. We see it a lot. So in short, you can't tackle this issue blind. Get the numbers, prepare a detailed wealth report showing exactly what you have now, your assets, liabilities, not that you want them, but everyone's got them, and where it is, whether it's in property, whether it's in pensions, whether it's in your business, whether it's in investments or cash. All of those, list them down. Very simply, just put on the left-hand side of it a bit of paper. Then, next to those, put the income that those assets are generating now at this current point in time. Once you've got that establishes your base position. That's where you are today. The whole point of this is to be able to plan for the future, plan ahead. So what I ask you then to do is, on the right-hand side of that, put another column. On this column, this will be your future date, the point that you, want to retire. It may not be when you retire. It's about having choice. It's about having options, you being in control. You might choose to retire. You might choose to exit the business and do something else. You might choose to carry on, but make that, whether it's 5 years time, 10 years time, 20 years time, put that right-hand column, and in that column, estimate how your wealth will grow. What will it be? You might have to make some assumptions of how things will change, how things will evolve. And at the same time, estimate what the income that those assets will generate. What will it deliver for you at that point in time in the future? It won't be perfect, it won't be accurate, but what it will start to do is highlight some real critical key principles that you can start to work on. Sitting down with an advisor, you can start to plan how to build the wealth in the right way, how to improve those income figures. And I guarantee that as soon as you start to do that, it will change your thinking, it will change your behaviors, and actually you can start to drive some action to help you achieve what you want in the future. So after the first question, we've established what your wealth is and where it is. The second question now becomes, what is the biggest risk to that wealth? The last thing you want to do is spend years and years hard work building up your wealth for your future, for it all to come crashing down around your ears and you to lose all of it or a significant proportion of it. So the good news is you can do something about it, but none of us have a crystal ball on what problems are around the corner. I don't suppose any of us this time last year would have predicted the global pandemic that arose, or things in the past, whether it be past recessions, whether it be economic collapses. It could be a claim against the business that an insurance company gets out of, something that happens that damages the reputation of the business, which reduces your trade. Could be your own health. Could be a disgruntled employee or a change of attitude from an investor or a funder that suddenly changes the risk profile of your business. The list is long, and if I haven't done it enough already and you really want to depress yourself, then I'm sure you'll come up with other risks for your situation and your business. But the good news is you can do something about it. We're talking about potential risks, and we all know that those potential risks can become real risks incredibly quickly. But if you think ahead, if you plan ahead, then you can do something about it. The greatest issue we see within our clients when it comes to wealth is that expression of having all of your eggs in one basket. As we covered in the previous question, most of our clients, we see 90 to 100% of their income coming from the business, and it often reflects 75 to 95% of their wealth. So a key step has to be to try and rebalance the wealth across other areas, moving wealth out of the business into either personal or other business structures to diversify your wealth and reduce the risk. Now, when it comes to moving wealth out of your business pot, that might be as simple as making a large pension contribution, sitting down before the year end, before it's too late, and deciding on a sensible amount to put in. Or it could be more complicated in terms of spreading that wealth in your business across other investments, across commercial property, residential property, and that might not mean taking it out. There are tax efficient ways within a structure of diversifying your wealth. Equally, for some clients, it's can you extract money tax efficiently from the business? That might be to pay off your domestic mortgage and build equity in your home, or just to invest in personal investments, generating an income outside of the business so that step by step you are moving reliance away from the core business activities. Sometimes this isn't as straightforward. It may be limited by tax rules, by pension rules. However, in all of these situations, there is often more than one way to achieve the end result that we're looking for. And with a creative technical advisor, they can make a real difference. Things that you thought you couldn't do because there was a tax consequence, that can be planned, done in a different way, achieving the same end result if you know a technical advisor that can come up with these sort of plans. So that part looks at moving wealth out of the business. The next bit is actually, can you de-risk within the business structure, within the business wealth? What we see is a huge amount of businesses actually operating through a single entity. That might be a partnership, not so common now for a sole trade, but more commonly it's a single company. Now, they've got everything in that one company, the trade, their assets, their machinery, sometimes property, all of that. If something goes wrong with that business, all of those assets are at risk. They are up for grabs from creditors, anyone that is owed money, and often what you see is the house of cards just collapses. Now, you can do something about that. If you have a group structure, and I'll talk a bit more about that in a minute, but if you have a group structure, you can separate the valuable assets from the day-to-day risks and keep them apart. In its simplest form, this could be two companies, a holding company at the top, owning things like property, IP, patents, websites, even machinery, and that's held up here. And then you have a subsidiary, a trading business down below, running the trade, running the risky activities. Now, if that's structured and set up in the right way, again, has to be done in the right way, but if there is a catastrophe in the trading business, the value in that holding company can be protected. It can be ring-fenced, secured, and you can make sure you don't lose it, or certainly you don't lose all of it. Now, that's in its simplest form. You can take that a step further, where if you have a bigger group structure, where you might have a holding company and then two separate subsidiaries down below. I guess use an example. Why would you do that? A care home could be a brilliant example, where they might have in the holding company the freehold properties, the valuable assets, and they might rent them to the trading subsidiaries down below. And you might have one trading subsidiary for one care home, a second subsidiary for a second care home. Now, if something happens in one of those homes, it can, if structured in the right way, cannot affect the second home. Equally, if something happened that was disastrous in both homes, then it can not affect the properties that are kept up in the holding company. So it is all about ring fencing the assets and the risk and trying to segregate them. For your businesses, it might be, I use the example of two different care homes. It doesn't have to be two different locations. You might have different income streams within your company. and it might be worth separating those. One of those income streams might be fairly recurring, low risk. Another one might be high risk, higher investment and things like that. And you separating those could be a good decision. So the key, as we started, I think, is to know where your wealth is, and once you know where it is, you can then start to plan to rebalance it. And in rebalancing it, what you're trying to do is make it less reliant on the business. And then within that business is splitting the value from the trading risk. And whilst tax issues must be considered carefully, you need careful planning. There doesn't have to be a tax cost to managing and protecting your wealth better. Often we speak to clients and they're told by an advisor, no, you can't move that, or you can't do that because it will cost you tax. That often isn't the case. There's often different ways of achieving the same result that can be done tax efficiently. So our final question today under the wealth and risk section is, how can I structure my business better to help diversify the risk within my wealth? A bit of a mouthful, but many business owners see the exit from their business as the way of achieving that. They've got to sell, they build their business for sale, and they keep building. And it's only at the end do they see that they can diversify, take the value out of their business and put it into their personal wealth. Now, if that's the plan that people are working on, over the last few years, there's been lots of things, whether it be Brexit, an election, pandemic, all of those things that have stalled people's plans for that, or actually made them look seriously at trying to cash out effectively. In some markets, there is still huge interest, high values being achieved for business sales. For example, in the care sector, where incomes are regarded as more secure, there's more workforce availability now, better than there's ever been. Valuations and buyer interests are better than it's been for a long time. The businesses are underpinned by properties. It's actually an attractive proposition still. However, others in tourism, leisure industry, as you can appreciate, the enthusiasm for acquiring a business in that market is currently fairly low. Now, if the value of your business is currently high, then there actually are many investors looking for a better return on their money at the moment than the incredibly low interest rates they're getting on their cash. Easier access to cheap money in terms of funding. There may be opportunities, if your business is attractive at the moment, to actually cash out. That might be an option to consider for de-risking. However, that is a sort of a fairly, fundamental end. You sell the business, it's gone. So a few of our clients are actually starting to look at ways to tax effectively sell part of their business. Now that might be to their employees. There are complicated issues around it that we're going to take far too long to talk about here. Can cover a whole topic on management buyouts and things. But it is possible to realise part of the value of the business tax efficiently, giving some autonomy to that next level of management. They might give them the opportunity to buy more shares over time, but also you can reserve the right in doing that to step back in if it's going off track. So you can still effectively retain some form of control. Taking some of your chips off the table in that way by extracting a chunk of money now, allowing the team to take on more of the management, can be an attractive option for many owners at the current point in time. The engagement of the management team in the business can also help to drive not only their enthusiasm, but actually grow the business going forwards. It can put a new injection of enthusiasm, motivation, ideas in, so that actually the bit that you leave behind on the table may actually even be worth more in the future. So you can get the best of both worlds. It also gives you the opportunity, the money that you take out, the part that you do sell to the management team, it gives you the opportunity to diversify that part of your wealth elsewhere. So I guess what I'm trying to highlight in this point is actually the key issue is to actually explore and understand all of the options for realizing the value of your business. It doesn't have to be a all or nothing sale. There are other options where you can achieve a part sale and actually have other benefits as well, such as involving the management team. That said, a simple sale of the whole thing may be the right option. That could be to a single buyer. Sell the business to a buyer and you move on. It could be getting equity investors in, so they buy in, you get the opportunity to take some cash out, but you still carry on as you did. You still carry on running the business. Or there are various ways to extract value, pass the business on to maybe the next generation of family or employees in a tax efficient way, as I've mentioned. I think the key is to take advice and understand your options. What we see is all too often business owners build the business, and they build to the point in time, a day when they think they're going to sell the whole thing. Often something happens around that, like we got at the moment in the current environment, that means they don't achieve the value they thought they were going to achieve. So if that is the case, why not have a look at whether you can sell part or do something along the way, or even whether a full-on sale is the right course of action. Key is, what we're saying is explore your options. Even if you don't do it now, it gives you information you can use over the next few years to build the business, or when the time is right to actually sell it. So in closing, if you keep going on without a plan, then you may see that inevitable blackjack result. Twist, 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 keep twisting. Eventually you will go bust at some point in time. If that happens when all your chips are on the table or all your eggs are in one basket, then it really will be a complete catastrophe. All those years of hard work building your wealth could be gone in an instant. So on that cheery note, don't let yourself be the catastrophe. Don't let your business be the one that falls over like a house of cards, because the key message is it doesn't need to be. You can plan ahead. You can put the right structures in place to protect everything that you've built up over the years.